There is one bank mistake that Canadian seniors are making right now in 2026 that can trigger a CRA investigation, a FINTRAC flag, or, in the most serious cases, a referral to law enforcement. And the people making this mistake are not criminals. They are not hiding money from the government. They are careful, responsible Canadians who heard something about bank reporting rules at some point and have been quietly making this mistake for months or years without any idea of the consequences. I want to be direct about exactly what I am describing, because the way this topic is usually explained gets the details wrong in ways that create unnecessary fear on one side and dangerous overconfidence on the other. The mistake is not keeping money in a bank account. It is not earning interest on your savings. It is a specific behavior that people adopt when they hear about banking transaction reporting rules for the first time and decide they want to avoid being reported. My name is Susan Harper. I have spent 14 years as a certified retirement planner working with Canadian seniors, and this is the conversation I have most often wished I could have with people before something went wrong, rather than after. Let me start from the beginning. Under Canada's Proceeds of Crime, Money Laundering, and Terrorist Financing Act, every financial institution in Canada, every bank, every credit union, every trust company, is required to report to the Financial Transactions and Reports Analysis Centre of Canada, known as FINTRAC, anytime a customer makes a cash transaction involving 10,000 Canadian dollars or more in a single transaction. This report is called a large cash transaction report. The report is filed automatically within 15 days of the transaction. The customer does not sign anything. The customer is usually not told. The report goes to FINTRAC, Canada's Financial Intelligence Unit, where it is added to a database of financial transaction information. A large cash transaction report is not a problem on its own. Tens of thousands of these reports are filed in Canada every year. The vast majority result in nothing at all. FINTRAC analyzes the reports, identifies patterns that may be relevant to money laundering or terrorist financing, and discloses intelligence to law enforcement only when there are reasonable grounds to believe the financial activity relates to criminal activity. For the ordinary Canadian making a large, legitimate cash deposit, the report sits in a database and nothing happens. The problem begins when people find out about the $10,000 reporting threshold and decide to stay under it. Here is the specific mistake. A senior hears about the large cash transaction report. Their immediate instinct is to avoid it. They start making deposits of $9,000, or they split a large sum across several trips to the bank. Or they make several smaller deposits over a few weeks, each below the reporting threshold. The name for this behavior is structuring, and it is a federal criminal offense under Section 462.31 of the Criminal Code of Canada, which relates to money laundering. Structuring is defined as breaking up a transaction or a series of transactions specifically to avoid a financial reporting requirement. The Criminal Code does not require the money to be from an illegal source. It does not require criminal intent beyond the intent to avoid the reporting threshold. If you deliberately structure your deposits to stay below $10,000 for the purpose of avoiding a large cash transaction report, you have committed an offense regardless of where the money came from. The penalties under the Criminal Code for money laundering-related offenses, including structuring, include a maximum of 10 years imprisonment on indictment. The threshold for prosecution is generally reserved for more serious cases, but the seizure of the funds involved can happen through civil forfeiture long before any criminal charge is filed. In addition to the criminal offense, structuring behavior is one of the most reliable triggers for a suspicious transaction report. Unlike large cash transaction reports, which are triggered automatically by the dollar amount, suspicious transaction reports can be filed by a bank on any transaction, regardless of size, when bank staff or automated compliance systems have reasonable grounds to suspect the transaction is related to money laundering or terrorist activity financing. Deliberately staying below the $10,000 threshold, especially if the pattern is consistent and repeated, is one of the clearest indicators of suspicious activity that bank compliance systems are specifically trained to identify. When FinTrack receives a suspicious transaction report and the analysis indicates potential criminal activity, it can disclose financial intelligence to the RCMP, CSIS, or CRA. CRA does not have automatic access to your bank accounts, but it can receive FinTrack disclosures when they are relevant to tax enforcement. A FinTrack disclosure to CRA can trigger a tax audit of your complete financial history, not just the transaction that prompted the report. Let me tell you about a situation I have seen play out with clients. A retired couple in Ontario had sold a vacation property and received a significant payment in cash from the buyer, an unusual but not illegal arrangement that both parties agreed to. The husband decided to deposit the money carefully, making several deposits each just under $10,000 over the course of a few weeks. He was not trying to do anything wrong. He simply wanted to avoid drawing attention to the transaction because the amount felt large. His bank's compliance system flagged the pattern immediately. Multiple deposits in consistent amounts just below the reporting threshold over a short time period is one of the most common structuring signatures. A suspicious transaction report was filed. When CRA received the disclosure, they opened an audit of the couple's tax affairs, including reviewing the sale of the vacation property for capital gains reporting. The couple had done nothing wrong in terms of their actual tax obligations, but the audit process took over a year, cost thousands of dollars in accounting and legal fees, and caused significant stress, all because of a well-intentioned decision to avoid a reporting threshold that would have created no problem if the deposit had simply been made in full. The correct way to handle a large, legitimate cash receipt is simple. Deposit the full amount in a single transaction. The large cash transaction report is filed automatically. It goes to FinTrack. Nothing further happens for the overwhelming majority of legitimate transactions. If a bank teller or compliance officer asks about the deposit, answer briefly and honestly. I sold a property. It is from the proceeds of a sale. I received it as a gift or an inheritance. One sentence, no elaboration required. Keep documentation showing the legitimate source of the funds, a copy of the purchase and sale agreement, a lawyer's trust account statement, a letter documenting an inheritance, a bank transfer record from the original source. This documentation does not need to go to the bank at the time of deposit, but having it available in case questions arise later is simple and prudent. Now let me address the CRA dimension of this conversation more specifically, because it is separate from FinTrack and affects a broader group of Canadian seniors. CRA has its own data gathering mechanisms that are distinct from FinTrack reporting. Under the Income Tax Act, financial institutions are required to report interest income paid to Canadian residents to CRA on a T5 slip. If you earn more than $50 in interest from a bank account in a calendar year, your bank files a T5 with CRA and sends you a copy. CRA matches the T5 information against your tax return. The specific issue that is affecting a growing number of Canadian seniors in 2026 is interest income that appears on a T5 but is not reported on the tax return. This can happen because the senior has stopped filing tax returns, assuming they owe no tax. It can happen because the T5 arrived in the mail and was overlooked, or it can happen because a senior has multiple accounts at multiple institutions and lost track of one of them. When CRA's automated matching system identifies a T5 that does not correspond to reported income on a tax return, it issues a notice of reassessment. If the unreported interest is above a threshold, it may trigger a more comprehensive audit. The solution is straightforward. File your annual tax return, even if you believe you owe no tax. As I described in my previous video, GIS eligibility, the Trillium benefit, the GST credit, and several other programs all flow through the tax return. Filing each year ensures CRA's records are current and prevents the discrepancy that a missed T5 creates. Let me also explain something about TFSA accounts that is a source of genuine confusion and that I want to address clearly. Interest and investment income earned inside a tax-free savings account is genuinely exempt from income tax. It does not appear on a T5. It does not need to be reported on your tax return. The T in TFSA means the income is tax-free. However, the contributions you make to your TFSA are tracked by CRA against your available contribution room. If you over-contribute to your TFSA, CRA will assess a penalty tax of 1% per month on the excess amount. Over-contribution is one of the most common CRA issues affecting seniors with TFSAs who do not track their lifetime contribution room carefully. Your available TFSA contribution room depends on your age, the years you have been a Canadian resident, the amounts you have contributed and withdrawn in prior years, and the annual addition to contribution room that occurs every January. The easiest way to check your available room is through your CRA My Account at canada.ca. If you are unsure of your current contribution room, check before making any new TFSA contribution to avoid an inadvertent over-contribution. Now let me address where your savings should actually be sitting in 2026, because keeping large amounts in a standard checking account earning minimal interest, while more competitive options are available, is one of the most consistent patterns I see. High-interest savings accounts at online banks in Canada are currently paying between 3.5% and 5% annually. These accounts are fully protected by the Canada Deposit Insurance Corporation, up to $100,000 per depositor per institution. Contrast that with a standard savings account at a major Canadian bank earning 0.1% to 0.5%, and the difference on $100,000 is $3,000 to $4,500 per year. GICs, Guaranteed Investment Certificates, at competitive online institutions are offering rates between 4% and 5.5% for 1 to 5 year terms. GICs at major banks are typically significantly lower for the same terms. The CDIC protection limit of $100,000 per depositor per institution applies separately to deposits at each CDIC member institution and separately to different deposit categories, including deposits in your own name, joint deposits, RRSP deposits, RRIF deposits, and TFSA deposits. A senior with significant savings can hold substantially more than $100,000 at a single institution with full CDIC protection by using multiple deposit categories. Check the CDIC website at cdic.ca for a deposit protection calculator that shows your exact coverage based on how your accounts are structured. The framework for managing your savings correctly in 2026 is this. Keep 1 to 2 months of living expenses in your day-to-day checking account. Keep 3 to 6 months of expenses in a high-interest savings account at a competitive institution. Place longer-term savings in GICs laddered across different maturity dates to provide both competitive returns and regular liquidity. Verify your CDIC coverage to confirm your savings are fully protected. And file your tax return every year so that CRA has current information and your benefits are assessed correctly. When you receive any large sum from a legitimate source, deposit it in a single, clean transaction. Keep documentation of the source. And do not split the deposit to stay below reporting thresholds. The report that follows from a single large, legitimate deposit is routine. The investigation that follows from a pattern of structured deposits is not. Send this video to one person in your life who has recently received or is expecting to receive a large sum of money and who has not had this conversation before. The difference between handling a large deposit correctly and incorrectly is the difference between a routine banking transaction and an investigation that takes years to resolve. I will see you in the next one. Let me go deeper on several aspects of this topic because the overview I just gave you is the foundation, and the details are what make the difference in practice. On the FinTrack reporting system, I want to address a question that comes up consistently when I discuss this with clients. People ask whether keeping money in a TFSA or a registered account protects it from FinTrack reporting. The answer is no. FinTrack reporting is triggered by cash transactions at financial institutions, not by the type of account the money ultimately goes into. If you walk into your bank and deposit $10,000 in cash into your TFSA, a large cash transaction report is filed exactly the same as if you deposited it into a checking account. The TFSA status of the account is irrelevant to the reporting obligation. What matters is the nature of the transaction, specifically that it involves $10,000 or more in cash in a single transaction. On the CRA audit risk dimension, I want to be specific about what triggers CRA attention for ordinary seniors, because the concern about large cash deposits can cause people to worry unnecessarily about their broader tax situation. CRA's audit selection process uses a risk scoring system that considers factors like income level, types of income, consistency with prior year returns, industry and occupation, and specific red flags from information matching. For a retired senior receiving OAS, CPP, and modest investment income, whose tax return is consistent year over year and whose T5 information matches what was reported, the risk of a CRA audit is genuinely low. The situations that elevate risk are specific: unreported T5 income from a missed slip, a significant discrepancy between reported income and lifestyle indicators, a large sale of property or assets that was not accompanied by appropriate capital gains reporting, an RRSP or RRIF withdrawal that was not reported as income, or exactly the kind of structured banking behavior I described earlier that generates a FinTrack disclosure to CRA. For most seniors who file their returns accurately and completely each year, the CRA audit risk is modest. The structuring mistake is not one that ordinary law-abiding seniors face if they understand the rule. Once you understand the rule, the correct behavior is straightforward and creates no exposure. On the CDIC protection system, I want to address a specific situation that affects many retired Canadians who have sold their home and are holding the proceeds while they decide what to do next. The sale of a principal residence in Canada can generate a significant lump sum. For a couple who bought a home decades ago and sell it in today's market, the proceeds can easily be $500,000 or more. The principal residence exemption eliminates the capital gains tax on that sale in most cases, which is one of the most valuable tax provisions available to Canadians. But the proceeds still need to be held somewhere after the sale, and many seniors park the entire amount in a single bank account temporarily. At a single bank, a single depositor is protected for $100,000 in each eligible deposit category. For a retired couple with $500,000 from a home sale, the straightforward protection structure would involve deposits at multiple CDIC member institutions, or a combination of individual deposits, joint deposits, and registered account deposits at the same institution to cover more of the amount. However, there is also a specific CDIC provision that applies to the proceeds of a home sale. CDIC provides temporary protection for large deposits called eligible deposits in trust in specific circumstances, and the regular deposit categories can provide more coverage than people realize when accounts are structured correctly. Contact your bank or financial institution when you receive a large lump sum and ask specifically about CDIC coverage for the amount you are depositing. CDIC's website at cdic.ca has a coverage estimator that takes 15 minutes to use and gives you a precise picture of your protection. And do not rush the decision about what to do with a large sum from a home sale. Taking 3 to 6 months to evaluate your options while the money sits in appropriately protected accounts is a sensible approach. GIC laddering, where you divide the proceeds across GICs maturing at different intervals, provides both protection and liquidity while earning a competitive return. On the TFSA contribution room issue, I want to give you the practical steps for checking your current room through CRA My Account. Log into your CRA My Account at canada.ca. If you have not registered, the registration process takes about 30 minutes using your social insurance number and your most recent tax return. Once logged in, navigate to the TFSA section. Your current available contribution room is displayed, calculated based on your complete contribution and withdrawal history. The common mistake that creates over-contributions is misunderstanding the re-contribution rule. When you withdraw from a TFSA, the withdrawn amount is added back to your contribution room, but not until January 1st of the following year. If you withdraw in August and re-contribute in October of the same year, you have over-contributed for the months of October, November, and December, and CRA will assess the 1% monthly penalty tax on the over-contributed amount for those months. Always wait until January 1st of the following year to recontribute withdrawn TFSA funds. For seniors who have been contributing to TFSAs since they were introduced in 2009, the lifetime contribution room is now substantial. As of January 1st, 2026, the cumulative contribution room for someone who has been eligible since 2009 is $95,000. If you have never contributed and are now starting, you have up to $95,000 of room available immediately. Let me close with the complete picture for managing your banking and financial records correctly as a Canadian senior in 2026. File your annual tax return, even if you owe nothing. GIS, the Trillium benefit, the GST credit, and CRA's ability to assess your T5 income correctly all depend on a current return being on file. Free tax preparation is available through CRA's Community Volunteer Income Tax Program and through tax clinics operated by many senior centers and community organizations. When you receive a large sum, deposit it in a single transaction. Keep documentation of the source. Let the reporting happen. It is routine. Do not split deposits to stay below reporting thresholds. The split is what creates the problem, not the large deposit itself. Check your TFSA contribution room through CRA My Account before making any new contribution, especially if you withdrew TFSA funds in the prior year. Review your savings accounts to ensure you are earning competitive rates. The difference between a standard account and a high-interest savings account, or GIC, on $50,000 is $1,500 to $2,500 per year. That is real money for a senior on a fixed income. And confirm your CDIC coverage is adequate for the amounts you hold at each institution. Full coverage is available for much larger amounts than most people realize, with the right account structure. Your financial affairs are your business. The rules that govern banking transaction reporting in Canada are designed to catch money launderers and terrorist financing, not to inconvenience ordinary seniors making legitimate deposits. Following those rules correctly, which means depositing large sums openly and in full, actually protects you. It is the attempt to avoid the rules that creates the exposure. I will see you in the next one.